Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. This is another in a series of videos I'm making about this compounders portfolio that I have, where I add at least $500 a week into this portfolio and see how quickly it can grow. I did the first in this video series around August of last year, so we're right around the 1 year mark, and it's nice to see how that's growing. At that point, the portfolio was in the $62,000 range. I did a second video when it was in the $82,000 range in February, and now we are above 100K, which is nice to see. So it'd be nice to revisit this video and talk about why $100,000 is always thought of as the hardest part of investing, and it gets easier from there. Before we jump into that, obviously it's hard to complain around this graph. Obviously, we had the little dip over here in April where the portfolio went from $82,000 to $69,000 at the lowest point. Despite the contributions flowing in, I did make some changes in this area where I added a few tech stocks, removed a few other stocks. I'll talk about that in a second. But now the stock market is soaring to all-time highs again. Everything looks amazing, and we're hitting that $100,000 mark pretty quickly. Obviously, a lot of that is from the contributions. When you think about $500 a week, that's not nothing. That's a lot. We're adding $26,000 a year in contributions, and sometimes I throw in another $100, $200, $300 when I have it into this portfolio because I want to see this grow. I want to see what happens. This isn't all my money. I have other investments. The majority of my investments are in index funds, the S&P 500 and the like, but I like to have some fun with my money. I do have a finance degree, but as always, this is not investment advice, guys. Please do your own due diligence before making any investment decisions. I am just doing this for fun to see how this portfolio can grow, to see how these side investments I'm making can do in relation to other investments I have out there. And I've talked about those portfolios before. There's obviously my small stock buyback portfolio that I've done videos on. I can link those down below as well. There's another individual stock portfolio I have that's focused on companies like Nebius. I've been adding Reddit to there. I have, some of the big four as well, and a lot of those companies are doing really well. That portfolio is up something like 45% in the last year, which is crazy. So it's beating this portfolio. It's beating the S&P 500, but this portfolio is lagging the S&P 500, which again, I'm not too upset about. This is a long-term strategy. Sometimes it will beat the S&P 500. Sometimes it will lag the S&P 500. You can't be upset about a 17% money-weighted return, but the S&P 500 is up about 22% in the same time frame, so that's important to keep in mind when you think about overall returns. This may seem good, but I would have been just as well off, even better off, investing in a simple index fund, which I do. The majority of my money, like I said, is in those index funds, including the S&P 500. And the reality is the S&P 500 is kind of top-weighted these days. You think about NVIDIA, Microsoft, and Apple. Those three companies make up 22% of the S&P 500. You add Broadcom, Google, Amazon, maybe Tesla, you're probably talking about 33% of the S&P 500. So if those companies do really well and you don't have those in your portfolio, you're likely lagging the S&P 500. If they do poorly and you avoid those, you're beating the S&P 500. So that's something to keep in mind. Right now, the S&P 500 is driven by a lot of tech stocks that are doing pretty well because of the AI investment boom. And there's a lot of companies out there in the S&P 500 that are being left behind because they're just not really participating in that. So maybe a lot of value there, maybe a bit of an overexposure to the tech side in the S&P 500. So I do like to have some diversity. I still have some of those tech stocks here. You've got Broadcom, which is a really good performer for me in the last year. Google I added just a couple of months ago. Amazon I added after the recent dip. And I removed some other companies. I think Walmart was just too expensive for me at a certain point. I don't want to pay 45, 50x for a grocer, a retail player. I still have Costco in here, but it's sort of in the same vein. It's kind of expensive. I do think that companies like Walmart and Costco should technically do well during a recession, but they're just so pricey that the long-term returns might be low single digits maybe. That's just something to keep in mind. So that's something I'm considering around Costco. I removed MasterCard as well when I replaced it with, Amazon and Google, and just wanted a bit more of a tech focus in this portfolio versus the retail focus that I had before. I also had a couple of private equity players that I removed from here and sort of have in other areas as well, but I didn't want the exposure to be as heavy on the private equity side because one of my biggest stock holdings is a private equity player in Brookfield and the various Brookfield plays that are out there. But this portfolio has gotten smaller, a bit more concentrated. I think I went from 21 stocks down to 17. I do have some cash here, so that's something I have to use at a certain point. And this portfolio was like close to 10% cash before I bought Amazon and kind of reallocated to other plays because I just didn't want to have that much cash in a portfolio that's supposed to be actively investing. I already have a bunch of cash on the side in other areas, so I want to make sure that I use the money here and invest it as much as possible. I do realign some of the targets based on what I think is valued fairly. Right now, it seems like there's a buy happening this morning that's going towards Roper, Waste Management, and CTAS. But you can see the portfolio in general, Broadcom, MCore, an infrastructure play, TSM, so some tech exposure, Roper, another tech player, Main Street, a BDC, Google, S&P Global, two garbage companies. I do like my garbage companies. They should do well in a recession because garbage comes and garbage has to go, and these companies do that well. Waste Management, Waste Connections, two biggest players in the United States. And a lot of these companies, what they'll do, and this comes into play with all of these companies, most of these companies, is one, they generate a ton of free cash flow or a good amount of free cash flow. They invested back into the business for sure, but they also use it to acquire stock. Some of them pay a dividend, acquire their own stock. Some of them pay a dividend. And a lot of them are buying companies every single year. Roper does a lot of that. They grow by acquisition. MCore does a lot of that. It grows by acquisition. Some of these other tech companies are eventually going to grow by acquisition. And that's kind of what I want. I want that churn of overall compounding where a company, grows their earnings, uses those earnings to invest in the business, buys back their shares to reduce the share count, acquires new companies that they can use to further grow their top line, their bottom line, and kind of continue that cycle of growth. And I think, I focus on those companies. I want this portfolio to be relatively hands-off. I'll look at it every quarter or so, see if I want to make any changes, make some adjustments. But in general, I sort of just let the $500 flow in every single week and hope that, 5 to 10 years from now, it's going to be a much higher number than today. So far, it's working. Obviously, I was sitting at 62K when I started this just a year ago. Now I'm at 104K. It's a combination of market returns, dividends, but primarily contributions at this point. That's kind of how it works. That's kind of how it works early on. And now that I'm at 100K, those contributions, because it's so much, are still going to make a bigger part. But I'm also going to start getting more money in compounding growth because 10% off of 100K is $10,000, and if I have a 20% year, it's $20,000. So that's going to become a bigger part of the return story. And when you combine that with the additional money flowing in every single week, that's going to make for a nice snowball of returns going forward. And now going back, I wanted to talk about why people often say that the first 100,000 is the hardest. Now we've got a spreadsheet. I know everyone loves spreadsheet. We've got this situation where every single year a person may add a certain amount of money and see how quickly it grows at an 8% return rate. So over here, we've got a portfolio that starts at zero in year one. When the person, let's say, is 21 years old, they add $5,000. They see $400 in growth. Their portfolio ends at $5,400 at the end of year one. And you sort of go down the line here. And the reason people say that the first $100,000 is the hardest is kind of evident by the amount of time it takes this person to get to that level. If you look at the portfolio, it takes this person 36 years to get to $1 million. That's quite a long time, but you're only adding 5K. You're getting to $1 million despite only adding about 180,000 to the portfolio in that time frame. So a lot of this comes from growth, but the reality is that growth doesn't happen until well into your investing journey. So when you look at the first $100,000, it takes you, in this example, 12 years to get to $100,000. So you're 10% of the way there to $1 million, but you're 33.3% of the way to $1 million time-wise. So it feels very long to get to that first 100,000. That's why people say the first $100,000 is the hardest in situations like this one where contributions are low. And then it gets faster. And the reason it gets faster is because your growth that you're getting, that 8% growth, is coming off of a higher base. So, in year 12, you're contributing $5,000, but getting $8,000, almost $8,000 in growth. That's a big difference from the first year where you contributed 5K, but only got $400 because your base was so much lower. So once you hit 100K, and even before that, your growth eventually starts eclipsing the amount of money you contribute. So it may take 12 years to get to the first 100,000, but then 100,000 to 200,000 only takes you about 6 to 7 years. That's, much faster, still very slow in relation to the length of our lives, that is. You're talking about 18 years to get to 200K. But at that point, you're 50% of the way there time-wise to get to $1 million, because growth really starts to compound on top of that. And again, this is a very simplified example. You're talking about consistent contributions. You're talking about 8% growth every single year, not a realistic situation where you might have a 17% return one year and negative 10% return another, and so on and so forth. Overall, it will come out to 8%, but sequence of returns makes for a different story than what we're seeing here. And sequence of returns is essentially what I said. Like if you have, two negative 10% years before a 50% increase, that's different than the average of that every single year in terms of what your portfolio ends up at the end of the year. So over here, we're doing a simplistic view, but as you kind of go down the line, once you hit 400K, you're suddenly getting 18, 20, 22,000 in growth every single year. So, it's 12 years, down to 7 years, down to 5 years to get to 300K, down to 3 years to get to 400K, and so on and so forth. So really, once you're really past that cycle of 100K, 200K, etc., maybe it should be the first 200,000 is the hardest, but really it takes you so much longer to do that first part of the journey where you may only be 20% of the way there or 10% of the way there, but you're 33 or 50% of the way there time-wise. That's why that common trope is that the first $100,000 is the hardest, because it feels so long to get there. You're only contributing 5K, and that is going to take a while to get you to 100,000 before you see that turnaround where growth starts eclipsing your contributions, where growth starts taking your contributions all the way over. By year 30, for example, you're still contributing 5,000 a year, but your growth is 45K because your baseline is so much higher. By the time you hit $1 million, it's 5,000 a year, but you're getting $74,000 in growth. By the time you're ready to retire here, you're sitting at $5,000 a year in contributions. Your portfolio is getting $154,000 in returns, and you're ending up with $2 million in the portfolio, assuming $5,000 every single year and 8% growth every single year, which is, again, overall not that realistic. It's not going to happen in this simple sequence, but 8% returns are a reasonable assumption. If you go to 10% returns, which you certainly can within this spreadsheet, I can maybe make a version of this in Google Sheets if anybody is interested. Just let me know in a comment down below if you'd like to see that. And again, you can play around with these numbers. Obviously, this is a simple example. If you're putting in more money into the market every single year, the first $100,000 thing might not apply to you. If you're putting in $100,000 into the market every single year, the first 100,000 is not going to be the hardest because you're getting there in 1 year. For me, when I think about 26K going into the market every single year, I'm somewhere around here, maybe into year 3 of the overall journey. So I'm maybe 9-10% of the way there towards $1 million, but already close to 20% of the way there in terms of the timeline if I want a 10% growth rate. If I get a higher growth rate, obviously that's better. But the reality is that this is going to be a long-term journey. Even with all this money going in there, it's still going to take me 16 years to potentially get there. But it's not until, these years where I'm really going to start seeing the exciting growth that comes from the market returns outweighing the amount of money I'm putting into the market. And that's where this portfolio is really going to start to shine in my mind, and I've already seen that in some of my other portfolios. But when you start looking at, hey, I'm adding a bunch of money into this market, and I'm lucky enough to be able to do that, $500 a week is certainly nothing to sneeze at in addition to other money I have out there. I'm super lucky to be able to do that, and I know not everybody does that, but even if you're doing less, there's still a way for you to get to $2 million with just a Roth IRA contribution and an 8% market return like I showed. But for me here, year 8, year 7, whatever, once I'm hitting 200, high 200s, low 300s, I might still be adding 26K in there, but suddenly my market returns are going to be outweighing that. So I'm going to be getting 30,000, 35,000, 41,000, 48,000. That's when it's going to get super fun. And this is why rich people just always stay rich, right? Once you hit a certain point, once I'm sitting here, let's say if I was investing this from the beginning of my life, if I was just a rich kid who was getting 26K from my parents and I could do that every single year, put it into the market, once I hit $5 million when I'm 52, I'm getting, $500,000 in just market growth. That's, stock returns, dividends, etc. That's obviously not going to happen every single year, but even if you put that into a bond fund paying 4 to 5%, you're getting 250K. That's going to fund your life and you can keep investing the excess, right? So that's the reality of being rich. Like once you have millions of dollars, market returns are just going to allow you to be rich forever. So why are people rich? Because of compounding growth, because of stock market returns, because of the ability to have their investments just pay for their lifestyle. If I had this much money, $10 million and I could put in a 5% return, I would never work again. So I'm not quite there. Hopefully I'm going to get there eventually, but I'm not there at this point. That's just what I wanted to show here. Like, this is where we are in the journey. We're not that far along. It's going to take us a while to get to a spot where, we're sitting at $1 million. I would like this portfolio to eventually be at $1 million. That's my goal here. Kind of show you the path to get there. We've started at 60K. We've gotten to 100K within a year, which is nice because our returns have been greater than 10%, but that's not always going to be the case. You can't depend on 17% returns every single freaking year. I think we're going to get to a market that's going to have negative returns relatively soon. We've just gotten super expensive. There's a lot of excess in this market. It has to be washed away eventually, but that benefits this type of strategy where I'm investing weekly, where I'm continually buying. As long as I have companies in there that I think are going to look better than they look today 10 to 15 years from now, which I think I do, I'm going to be okay. So going back to the portfolio, taking a look at it again, let me know what you guys think about these companies. Let me know what you guys think about the idea that the first $100,000 is the hardest. Should it be the first 200K, the first 300K? What do you think? Let me know if you want to see the spreadsheet in Google Sheets. I can certainly link it down below. This is in Excel because I'm more comfortable with Excel formulas. And just let me know anything you want to see. Comment down below, like the video, subscribe, all of that good stuff. And I hope you're enjoying this series. I will certainly do more. If you want to see more of these videos more often, I can do that, but I just don't want to update too quickly. I think I'll update whenever there's milestones, if there's negative market reactions, etc. If this portfolio suddenly drops to 80K again because something very negative happens, I'll probably do a video, or when it reaches 125K or 150K or some other milestones like that. So thanks for watching. As always, like, subscribe, etc. And bye.